What are the drivers of real estate wealth? Well, there are three. The first is appreciation. Real estate values going up over time. The second is amortization. The fact that if you buy a piece of property with a mortgage, which most people do, that you're going to pay that mortgage down. Every single payment you make will chip away at your mortgage balance. And over time, you build wealth because as the top line goes up, the real estate value, the middle line, which is your mortgage balance, goes down. And the third category is cash flow. In an investment property situation, a rental property, you've got somebody who's paying you for the privilege of living in your property. And that cash flow, when it is positive, it will then contribute to your overall return on the investment. So I want to show you just graphically to get an idea of how powerful these three forces are. All things being equal, you buy a piece of property right now, it doesn't appreciate, you generate no cash flow, you don't amortize it, it's a total flat line. So your wealth, you parked your money someplace and you're starting out with an assumption of zero gain on your investment. But if you think of the three drivers of wealth in real estate as dials on a mixing board, that when you turn up one of the dials just a little bit, the return begins to increase dramatically. Now you take the second one, the amortization. You pay that mortgage off, turn that dial up just a little bit, and the curve gets steeper. Now you add to that the idea that over time, you'll be generating positive cash flow. Now I say over time because as you're going to see throughout this course, there are a lot of opportunities to buy under market properties with negative cash flow for a variety of reasons, and then turn those properties positive cash flow because of changes that you make, moves that you make with improving the property, changing the tenancy, all kinds of different advanced strategies that professional investors employ to increase their rent. So you may wind up looking at properties that are negative cash flow in the beginning, but know that over a few years you'll turn to positive cash flow. When you do that, you turn that dial up. This is what drives those numbers up past 5%, past 10%, and the longer you hold real estate, if you buy it at the right time in the cycle, which is where we are now for the next few years, and you employ the strategies that we teach you in this course, you'll wind up seeing that you can turn all three of these knobs, push all three of these knobs forward, and watch the returns on investment grow dramatically. Now the first category, appreciation. We've already talked a lot about this chart, so I won't go into it in depth, but even though we can't guarantee appreciation, given the history and given what's happened over the last couple of years with this overcorrection of the market, it looks like really, really good timing. But what's interesting about real estate appreciation is the impact of leverage on the appreciation. This is also a chart we've talked about already in this course, the 40-year single-family home chart in real estate. And because we're talking about comparing real estate returns with other asset classes, I'm going to use this opportunity to show you what the Dow Industrial, the stock market, performance looks like when overlaid on top of a housing chart. The shape and nature of these two charts is uncannily similar. They both did really well over the last 40 years, and at first glance you would think the stock market did better. Now, the housing market went up a little bit better than 700% during that period, but the Dow went up over 1,200%. So the people who say the Dow is a better place to invest your money than real estate are right. Right? Wrong. When you incorporate leverage into the equation, something very dramatic happens that leans very much in favor of real estate investing. And here's a very simple example. Imagine for a moment that you purchased a property for 100 grand and that property increased in value by 2.5%. So your property was worth $102,500 after a year. That return on investment is $2,500, which is a 2.5% ROI, right? Not right. The original investment was $25,000. That was your down payment. So you were able to leverage 100 grand worth of real estate for a 25 grand down payment. But the real estate went up by 2,500, so the actual return on investment was 10%, not 2.5%. Here's how it plays out on that long-term scale, where you use $25,000 not to buy the real estate for cash, but use it as a down payment for a $100,000 piece of real estate. That piece of real estate went from $100,000 to over $700,000, and that same $25,000 investment in the Dow resulted in a value of about $300,000. So the end result of a real-world investment in 1968 is your real estate is worth almost 2.5 times what your stock investment was worth. So real estate outperforms the stock market, and people know this, they've lived it, but again, because there's no statement showing you the return on investment, you wind up being subject to arguments like the Dow Industrial has outperformed real estate over the last 40 years. Well, technically yes, but in practice, absolutely not. The second driver of real estate wealth is amortization. Very simply, if you take a traditional mortgage, you pay that mortgage off. And you see here the 30-year amortization chart starts off kind of flat. The first couple of years, you're not paying that much principal down, but the longer you hold the real estate, the better your performance is on your amortization. Keeping in mind, of course, that you're not paying it. Somebody is paying your mortgage for you in the case of a rental property, which means that as they pay your mortgage balance goes down and your wealth factor goes up. Here's a 15-year amortization, which is straight off a cliff. I mean, you see right away your payments are dramatically digging into your principal balance. Driver number 3 is cash flow. That's where your rental income exceeds your operating expenses. And in the next video, we will go through the basic calculation of cash flow and show you how to do the figuring on that the old-fashioned way. In the next module, we're going to show you how to use some pretty cool software to do it all automatically. But just like when you learn how to do math in school, first you learn how to do it with a pen and paper, and then you learn how to do it the quick way and cut the corners and do it quicker. And there's some very powerful long-term forecasting technologies that we're going to share with you also. So to recap, we've got leveraged depreciation, we have amortization, and we have cash flow. And the three of these things, when driven forward together, can give dramatic returns. And the best part is that you have control over them. You have control over finding markets that have a higher than average appreciation rate. We're going to show you how to do that in this course. You have control over your amortization. You can pay that property down faster. And you even have control over cash flow because there are strategies to find properties that are generating under market rents. There are strategies to increase rents. There are strategies to reduce expenses. And so this is a small business. Real estate investing is not passive. You don't just buy a stock and then pray that the management team of that company runs it well. You have the opportunity as a real estate investor and as an advisor to investors to manipulate these dials on this mixing board, drive the volume of your appreciation and your wealth creation up, and create the kind of results that really do build wealth for people in America.